All right, guys, welcome back to another episode. Today I have Tyler Hodgson with me today. He is the founder of NTX Mortgage. Really excited to talk to him. I know I've been looking forward to it. He actually, we had Trevor Reed on the show some time back, that was last year, so as well. And so Trevor's a part of the same thing, but Tyler is the founder of NTX Mortgage. So as always, when we interview anybody or we talk to anyone, I like to start with origin stories, and that's just about where we start. So Tyler, take it away. How did you get started in mortgages? What was the beginning?
Yeah, I think like everyone, always a interesting way. I didn't grow up thinking I was going to be a mortgage. When I was in college, I was looking to get into real estate investing. I wanted to buy my first house, and I had previously served in the Marine Corps for 4 years. So I was learning about the VA loan. Great mortgage, low interest rates, 0% down, no PMI, perfect to house hack. I wanted to buy a house. I had roommates. I could rent them out. So I was talking to a local mortgage lender about getting qualified and buying that first house. And at the time, I was working a part-time job, and I was in college studying accounting. And the lender was like, "Oh, well, you don't qualify at this time because you're only working part-time." And I was like, "Well, I've got great credit. I pay all my bills on time. I've got money in savings, and I've got roommates who are going to help pay." And they're like, "No, that doesn't count." And I'm like, "I got the GI Bill from the military." And like, "No, that doesn't count either." So I couldn't qualify. I was frustrated because like the rent I was paying for the apartment was more than what the mortgage was going to be. And I paid the rent every single month. And you're like, why do I not qualify? So now when buyers come to me and they're in a similar situation, like, "Oh, I know what you're feeling. Like I've been through that." But that same company that I applied with for the mortgage, they couldn't qualify me at the time. They actually offered me a job instead. So I went for a mortgage and I got a job.
We'll help you in the future.
They needed some help with accounting and admin. It was like a smaller company, about 15 people at that company. And she was really impressed by my background in military and knew I was in college for accounting. So she gave me a shot, and I accepted that job. And the goal was to get me, full time there when I finished college, and then I'd be able to qualify for a house finally. So in 2016, I ended up being able to get that first house and had roommates and things like that. So that was kind of my start of both getting in the real estate world as well as getting mortgage. And she was convincing me to get my mortgage license, as a salesperson. I'm not a salesperson. I'm an accounting, behind the desk, numbers, computer kind of person. But she's like, "It's not like that. It's about building relationships. It's about, helping other people, and it's good work." And so ultimately I got my license and started doing more mortgages, and I realized I actually like doing this better than doing accounting. And I don't picture myself working a 9-to-5 accounting job. So just kind of went all in on the mortgage thing. And that's how it started.
I like how you came in for a house,
Got a job.
house hack, got a job, and then ended up, the next thing you know, years and years later, you're like, all right, open a mortgage business.
Now I'm a salesperson, and I start my own mortgage company.
Yeah. So kind of how did that come about, as far as going from, going to sales? And then, because that's another leap, right? There's people that don't take that leap. They'll just kind of stay there. And I don't think it's meant for everybody to take that leap. But what was it that made you say, "Man, I've got my license. I've been doing sales. I want to take that next step"?
Yeah, so I got licensed and started closing a couple deals and figuring it out. And surprisingly, I was very early in my mortgage career when I made the jump to start my own mortgage brokerage. I'd closed 12 transactions to my own name.
Yeah.
So anybody in real estate or mortgage, if you're like, you've done 12 transactions, you're like, "Oh yeah, that person's an expert. He knows everything there is." But I also kind of think like you do. Like if you do one transaction, like you know how to solve problems. Like you do one or two, you could pretty much figure out any transaction. So I closed 12 whole loans to my name when I decided to start my own company. And the previous company I worked for was just, they're very old school. They'd been in business 25 years, and I just thought that I could do it a better way. And I had a better vision for how I wanted to grow a company and build a team. So ultimately decided to make that jump. And when I did it, I was in, decent enough financial position. I had a couple properties at that point because I had the property I'd purchased plus a couple rental properties I had acquired. I was living very well below my means with roommates and my car paid off and didn't have a lot of bills or expenses. And I had a decent amount of money saved up to where I knew I could go a couple months without making another paycheck and I would be okay. So yeah, at that point I took the leap of faith and jumped right in to start my own company.
I like that. That's something that you don't hear a lot. Most people, they end up, they won't make that jump. You did 12 and you're like, all right, I'm straight. Let's go. Where some people are like, I got to do 1 million. And then I'm like, okay, now I
got to know everything about it before I do it.
Yeah. And you said, hey, I don't really need to know all about that. I just need to get after it. So I want to talk about house hack a little bit. Kind of tell us a little about that. Like kind of what was your experience with that? You said you bought some rental properties, you were living with roommates. I mean, what was that like kind of moving around those pieces and doing that?
Yeah. So originally I had this strategy that a lot of people have and see is like, okay, I'm going to buy one house, I'm going to buy a duplex or a quadplex. I'm going to live in one unit, rent out the others. Then I'm going to, a year later, move to the next one. Then a year later, move to the next one. And in 5 or 6 years, I'm going to have all these properties. So that was my original plan. I ended up, it was a hard time to find like any multifamily properties. Like DFW is always pretty tough for that. And so I ended up just buying a single family townhouse, 3-bedroom, 2.5 bath, had 2 friends who were roommates with me. So it was just, they were helping cover the payment. Like it wasn't even, I wasn't making a lot of money or anything. Plus they were friends. And so I was living with people I knew. And I just didn't want to move again. Like it was actually a brand new build. It was a brand new build. And after like the first year, I'm like, I really don't want to move again. And because I started doing mortgages, I started getting these nice commission checks and having more money available where I'm like, okay, well, I could just buy a rental property with 20% down. I don't need to go do the house hack thing every step of the way. And I was dating a girl at the time and, she had moved in. And so it just got to the point where I was like, hey, I'm not going to move every single year and get another house. So the first couple rental properties I did were, just save enough money for that down payment, get the next property, get it cash flowing, pretty much turnkey rental properties. Kind of dabbled in a few different things, partnered with some other investors on some flips and, just any way I could continue to build that nest egg and just invest a little bit of more money here and there and get some return. It was definitely the fun times those first couple of years of like, just let me hustle and I want to do any deal and I want to learn everything. So the beginner investor like excitement was a good time.
Yeah. So kind of jump back to real quick to you said that the old school, they were old school, the company you had worked for before, they were old school and they just kind of, what was it that you were like, you set out to do different? Because that's pretty common too. That happens when someone starts something new. They start a business. They're like, okay, I want to do that. I can do it better, or I can do it different, or I can make this value proposition or whatnot. What was it that said, hey, I want to do it this way? Like, because what was that differentiator? I guess you could put.
Yeah, we didn't want to have filing cabinets and paper documents, and this was 2016. So this company was kind of double working on a lot of things. It's like they had everything on the computer systems and they didn't have really great processes or great technology. And they had still paper files, everything. And there was a lot of staff and a lot of overhead. And I was doing the accounting too, remember? So I saw how much revenue they're making. So I see what they're charging the buyers and the borrowers, the fees and the rates and how much money they're making. I saw how much they're paying the LOs and I saw kind of all the overhead and I was like, I think I can just do this a little more efficiently where I can have less overhead, pay my loan officers better, and charge the buyers less so they can get better interest rates. And if I can accomplish all 3 of those things, that's a big win compared to where I'm currently at. And I always had this focus of like this team member centric model. Like if you take care of the team member, they'll take care of the customer. So I'm very employee focused of the best experience possible for a loan officer. And if you're a loan officer, we were kind of talking about it earlier, like the mortgage industry, heavy regulation, lots of processes, restrictions. So a lot of big companies just over restrict things and make them more difficult than they need to be because they just have to. So my goal is like, how can I simplify processes and not create just some dumb bureaucratic or corporate policy or rule just because it applies to 10% of the thing. Like let's be a little more common sense approach. So I want to create the common sense approach. And then, as I mentioned, being very team member focused, I never wanted to own 100% of nothing.
Mhm.
I would rather own 50% of something great than 100% of nothing. So I quickly developed like a team member stock program to share the company ownership with the team members who wanted to participate and those who are on the team. Because to me, that's like the ultimate goal of a business is if everybody's bought in on the vision together and they truly have ownership in it, they're going to do a good job and they're not going to make those mistakes and they're not going to, they're always going to work hard and they're going to take care of all their customers as well. And to me, as a business owner, that's going to bring me more value in the long term and help me grow faster too.
Is that common within the mortgage industry?
No,
You don't see that at all.
Definitely not. No,
Like that, the model itself. I hear that's awesome to,
Mhm.
the way you put it. That's just, you don't see that often then.
no, definitely not
Mhm.
common. I don't really know many other mortgage companies that are team member owned or have team member stock plans. It's just not very common.
So running a virtual team, I gotta say, like I see your pictures and stuff, and social media where I love the virtual setup. Just the way you have it set up, where you've got the huge TV and your meetings and stuff. I'm like, that to me, that's always like I gotta level up my meet because we do a lot of our brokerage is virtual. So I'm like, I see that, I'm like, man, like that's I admire that because the setup's always clean looking. It's nice. You're you literally got people in the room and people out of the room. What's that like running that when you start? Because and I ask that because on a business level, someone who listens to this, they're listening and they're thinking, okay, well, I've got a team because at the end of the day, at some point, real estate becomes a team, right? It's like you're running a team virtually at some level. Kind of delve into that. What's that like running that team and having a large team where you're running? Some people are with you there personally, and others are not connected in that manner. They're actual virtual.
Remote.
Yeah,
Yeah.
remote.
Yeah, so it's definitely that hybrid piece of like we've got an office, we have a physical space, we love our physical office. As you mentioned in the pictures, like it looks nice. It's very fun place for anybody to come in. You can feel the energy. I love being in the office because I love the energy of other people, and I recognize how hard it can be when you're working virtual and you're out on that island. And I mean, we all kind of experienced that through COVID, obviously.
Yeah.
So for me, every time we're doing, trainings and events, like even an event, like we'll do a game night or a trivia night at the office, and we're including the virtual team members in that with the live team members, and they'll be streaming on the TV. They're sitting at their house on their desk, like doing
Yeah.
trivia where there's like 30 of us in the room, and it can still be a little difficult for them because like we'll be having conversations in the room and you're just kind of like outside watching, but we try to find those ways to get everybody involved. And we do a lot of team building events so that those people who are remote can come in town from time to time and they'll come visit and be involved in some of those events. Everybody in our team is in Texas, so
Yeah.
they're within 5 hours of us. But they actually do make an effort to come out because they do want to be involved and be a part of the team. So that mix there is good. And yeah, just really being intentional about staying in touch with the people who are remote because they are going to naturally just feel more disconnected
Mhm.
than those who are in the office. And as a loan officer, just like a real estate brokerage, like you're not going to be in the office 24/7. It's not a 9 to 5 office job.
Mhm.
LOs are
Yeah.
out doing their own thing. People like to work from home. People like to mix it up, but having the office space is a central point where people can come in if they want to. That's been a really good benefit for us.
You better take note, Misty.
Just out of curiosity, would you say a lot of times the office is empty?
I would say Mondays and Fridays are more empty than others.
Yeah.
Sometimes it's only me and a couple of their support staff and not as many LOs in there. On any given day, we maybe have 4 to 7 LOs come in and out, and they might only be there for a couple hours in the morning or a couple of hours in the afternoon, so they're not there all day. On days that we have big team trainings or team meetings or an event, then the office is full and buzzing, and there's like 20, 25 people there.
You said 4 to 7, but how many do y'all have total?
So total LOs, we have 70.
Okay.
That's cool. So I was gonna say, I told Misty, you better take note because we argue about this, right? I like. So before we had the brokerage, we still have a jiu-jitsu academy, and it's very personal. You see you're talking to these people, you see them every day, same time, and it's just business wise. And to go from that to totally virtual, I'm like, Misty, we need an office. I keep telling her like we need to get an office, and I know where I want to put it. I haven't told her. I'm like, I know I want it to go right there, and where I want to get one, and in Fort Worth, and it's just. But she's like, no, we don't need one. We don't need one.
Magnolia.
That's on my list, but that's not one. But no. So it's interesting to hear kind of how you run that. The process behind that, because I would imagine, which kind of puts me to that next question is like, obviously if you're there, some people like that disconnected. I know I enjoy sometimes being disconnected and not being. I like to be. I'm the guy that likes to be in the back room and just let me build. Is that kind of your personality? You're like, or is like, hey, open door. Everybody, if you need me, just walk in, bust in the office, and start asking questions.
I'm definitely open door to a fault. And
Yeah.
it's kind of funny, like literally just earlier this week, it must have been Monday. I was in my office and like trying to watch this recording of like a Loom video of something I was looking at. And 3 different times people came in and interrupted. And like it's like a 2-minute video. And I couldn't get through it because people came in and asked me a question because we had a lot of people in the office that day. And when the third person came in, I'm like, oh my God, can I just finish this video? Like, please. So I definitely have open door policy, but the way I combat that is like, I'm an early bird. So my quiet hours, I've got to get my work done and my quiet time done early in the morning before my phone starts blowing up and emails start chiming and people start coming in. So I would classify myself as more of an introvert than an extrovert.
Yeah.
But I do like interacting with people, and I'm always like willing to help someone. If they show up in the office and they're there, then like I'm happy to support them.
I think that's interesting because introverts, you would think are the ones that maybe they're not going to be the ones to open a business or start something, but they almost always are. It's not. It's never the extroverts. The extroverts almost. I mean, not that they can't, but for whatever. Because I used to be very extroverted, and the further along we went, I was like, I'm a little more like I like to be alone.
Yeah.
And so it's kind of weird. You mentioned that you're like but you're like, hey, I'll do a podcast. You'll be out. You'll do what you need to do. But at the end of the day, you're an introvert.
Yeah.
And I find that interesting because that is the case with a lot of people. They're just introverted to a degree, especially when you open a business. So you manage that. You keep the door open, but at times you got to, but I like that. So you actually kind of schedule your time out a little bit to be able to say, hey, get everything done. So you can't just keep busting it because everybody wants you when they want you, right? Like it starts when you're busy. Like your phone's probably going to go off right now. You get done here. Once we get done, podcast talking, you'll be like, man, I got 40 notifications I got to deal with.
Yeah. Oh yeah.
But they didn't want you.
I'm already
when you were
dreading
driving.
it.
Yeah. They didn't want you earlier, right? They were like, oh no, you're fine, man. And then as soon as you get started, they're like, da-ding, da-ding, da-ding. Yeah.
Yeah. The thing about owning a company and like you realize I can send you a bunch of information. I can give you all the training. Hey, here's this video on how to do this. And then like, for whatever reason, nobody watches it. Nobody learns it. And then next week they ask you, hey, how do I do this? And you're like, I just sent something about that last week. It's like,
we started
right.
building a knowledge base.
Yeah.
I literally built a knowledge base in the back end. I was like, every question that comes through, I just put it in a knowledge base.
And no one's ever going to look at it.
Yeah.
It's let me Google that for you. That's my answer. Is like, all right, let me Google that for you. Like,
I'll tell them, hey, go.
So our response to each question as it pops up is the knowledge base link. Knowledge
go to
base
this
link.
link. Right. You got to start teaching them how to find the answer. And if you start just sending them the link and here's where to get it, that helps train them a little bit.
I'm like, it's just type it in, So we'll talk a little mortgages, man. So, you mentioned, to kind of circle back, you talked about VA. That was how you got started, was, looking for a VA loan. I remember that, in fact, I think it was put up, and you guys put it up, that VA loans, and it might have been Trevor, it was you or Trevor, but that they were the highest closing rate.
Mm-hmm.
Talk about that. You would never, like, that would never cross my mind that a VA loan would have the highest closing rate. I would think, more conventional, or FHA, you're out in the boonies. but I would think more conventional would be the one. So why is that?
Yeah, so I want to say, man, it was probably 6 or 9 months ago when I shared that stat, I feel like. And Trevor probably reshared it as well, but we got some interesting data, and it comes from the VA too. And they say, like, they showed the number of applications, the number of, contracts, and how many actually close. And I don't remember the exact stats off the top of my head. But VA loans are actually higher quality than conventional loans. And for whatever reason, VA gets this stigma that, oh, it's not going to close on time. And the buyer's not very well qualified because they're putting 0% down. Like, we talked about it with my origin story. I put 0% down because I wanted to. Like, I pay all my bills. I have great credit. I, had savings, but if I can leverage 0% down at a very low interest rate, maybe today at a high interest rate, but a lower interest rate than a conventional or an FHA, then a veteran should definitely be able to do that. So they are higher quality borrowers typically. The credit score and their financial situation is usually better than the average conventional or FHA buyer, and that just allows them to have a higher closing rate. The other thing is it's easier to get approved for VA. It does have a little more common sense approach on some of the underwriting guidelines where there's a little more flexibility, and they can qualify for a higher payment compared to their monthly income, debt to income ratio, because there's a couple different ways that you qualify for VA. With VA, you technically don't qualify based on your debt to income ratio. It's based on a different calculation called residual income, where it looks at how much money you have left over at the end of the month after you pay all your bills. So since it's a little easier to qualify, that gives them a little more wiggle room in a loan, where someone on the conventional side, if some number comes back too high or too low, all of a sudden they're denied and they can't close. VA loan has a little bit more wiggle room there.
Yeah. I always would have suspected the other way around, just from, but
the other stigma is the VA appraisal, and they're like, oh, well, VA appraisals always come back short. It's like, VA, they're like the VA appraiser, blah, blah, blah. And I'm like, the VA appraiser is the same appraiser that does a conventional appraisal, and they're picking the same comps and they're doing the same adjustments. They're not like just arbitrarily picking a lower number because it's a VA loan. So that's like a big myth that when I hear that and like an agent says that, I get pissed. I'm like, hold on a second.
It's not a government appraiser.
Yeah, exactly.
The bureaucrats coming out.
Yeah.
It looks like, what's that show? The bureaucrats, they were the Simpsons. Futurama. The bureaucrats come out, and so that's the same appraiser. So VA loans, that's something that and as far as like, do you see more VA loans than conventional? Like, do you kind of see, like, what you kind of stat wise, do you see more people coming through with those, or are you dealing with more conventional? I mean, is it kind of?
I have a pretty good mix just because of like my buyer pool and even our company as a whole. Like, we're always gonna have more conventional than VA just because there's more conventional buyers than there are veteran buyers. But I do a pretty healthy mix of everything. And even FHA, like FHA is becoming more prevalent now because FHA this year has lower mortgage insurance than it had historically. So the monthly PMI is less. And conventional got a little more strict on their different credit score buckets and how that affects the interest rate. So somebody who used to be a 700 or 720 credit would probably be better to go conventional than FHA. And you wouldn't really start hitting the FHA threshold till maybe 680 or 660.
Yeah.
But now if you compare the numbers side by side with the 720 credit score, FHA is actually still better than conventional. So although the borrower may qualify conventional, if they're working with the mortgage person who's actually giving them the options and showing them their best option, they may say, well, I actually want to do the FHA instead of the conventional because it's going to be a lower interest rate and a lower monthly payment, and it's going to provide a better benefit for me. So that's another thing where if a borrower has a pre-approval letter with an FHA loan and then the real estate agent is concerned, like, oh, what's wrong with their credit or, whatever. And I'm like, no, like, they've got good credit. They've got good income. They're just going to have a little lower monthly payment if they go FHA. So we're seeing some of that shift where there's going to be more and more FHA offers coming across the table for sellers and listing agents. And, they need to be aware and just ask the questions, like reach out to a loan officer and try to find out, like, why are they going FHA versus conventional? Is it because that's their only option, or is it because it's just better for them financially?
Yeah, that makes sense. I mean, if it's better financially, it's why not go that route?
Yeah.
Versus if it was a seller's market, then they might have more problems finding a property.
True.
Yeah. Yeah. We're in a buyer. So what, do you ever see anyone, it's just kind of with VAs, do you ever see people, obviously you can do 0% down. Do you see people come through and say, hey, I don't want to do that. I actually want to throw some money down. Is that a common thing, or are they all like, nope, I would go zero. That's just me. But I mean, is that?
You can always put it down later.
Very rarely. I would say out of all my VA loans, maybe 10 or maybe 20% ever put any kind of down payment. And normally those are the upgrade buyers where they're selling another house and they're just want to keep their monthly payment lower, so they want to just roll their equity and put a big down payment. But the majority of the time, most just leverage 0% down because it's the option.
Yeah. So I want to talk a little seller concessions, and that's something that we had come across just recently within our own sphere and our brokerage, and it's something I think some people may not recognize. We actually had Trevor on one time. He talked to all the agents and explained everything. Kind of we have the cheat sheet. We actually have you guys' cheat sheet that I use for the agents as well. But I want to talk about that. Talk seller concessions and kind of what some of the things that because I think some people may not be as familiar with what's possible, but what's possible. In certain loans, I know there's certain restrictions. You can only have a max seller concessions, that kind of stuff. So can you kind of run through that, the different, I guess maybe run through the cheat sheet, a little bit, kind of what that looks like.
Yeah. Just cut over in this video, show the screenshot. Cheat sheet. Is it here next to my face so I can point? So conventional one is a little tricky, so I'll do conventional last. But FHA and VA are pretty straightforward. FHA allows up to 6% seller concessions. That's 6% of the sales price or the appraised value. So if your appraisal comes in low, but you don't change the sales price, you're actually going to limit your seller concessions too. But if you have 6% in seller concessions, you're probably going to just adjust the sales price also. VA is 4% in seller concessions. But VA has also kind of a little tricky rule where that's 4% in addition to the seller being able to pay all the closing costs. So on a VA loan, the seller could pay all your closing costs and give you another 4% just to give it to you. And you could be putting 0% down. So you could get paid on a VA, like the veteran could walk away getting paid to buy that house, like more money in their pocket. And so that's a very uncommon thing in the past, obviously, but now veterans could actually leverage that and say, hey, I want to put 0% down. I want the seller to pay X amount of closing costs, plus I want them to give me some extra back. Whereas FHA and conventional, there's that max percentage, but the borrower can't ever get that money back. They can't get extra. So if my closing costs are only $5,000, but 6% of a $300,000 purchase is $18,000, you can't give me $18,000 in seller credits if all of my closing costs only equal $5,000, because I can't take the extra money and put it towards down payment. I can't do anything like that. So it's either use it or you lose it. So most of the time, an FHA loan is not going to have 6% worth of closing costs unless the buyer is paying down the rate with a lot of points, or they're doing something called a temporary rate buy down, which we can talk about that in a minute, because that's a common strategy right now because interest rates are so high. So normally they're not going to use that full 6%. Before we talk about the temporary rate buy down, we'll talk about the conventional loan. So conventional loan depends on the down payment amount. And depending on the down payment amount, the higher your down payment, the more seller concessions you're allowed to have, because they think that that loan is less risky. And if you're putting a low down payment, I guess they feel like the more seller credits you're getting, they call it a inducement to purchase. So I'm kind of like giving you all this extra money to try to get you to buy this house at a higher price than you maybe should be. So that's why there's these limits on seller concessions. So with conventional, you've got 3% seller concessions if you're putting less than 10% down. Then it jumps up to, I want to say 6% and then 10%. I'll have to double check that. But there's these tranches where if you're putting more down payment, you're allowed more seller concessions. Again, once you start getting above a certain level, you don't even have that many closing costs, so you're really not going to be able to use that many seller concessions anyways. And then that only applies for primary residence and second home on a conventional deal. If you're buying an investment property, it's very limited, and it's only 2% seller concessions. So I work with a lot of investor clients, obviously, because I'm an investor, and they kind of get it rough because they've got to put a big down payment, and then they can't get as much seller concessions to cover all their closing costs. So those who are really trying to get a property with as minimal down payment as possible are a little more limited versus a primary residence transaction.
Yeah. So tell me about the temporary rate buy down a little bit.
So temporary rate buy down is, I like to explain it to my buyers this way. It's sort of like a hybrid between a 30-year fixed loan and a adjustable rate mortgage. Mm-hmm. We all know adjustable rate mortgage is the interest rate is going to adjust over time. You may have a certain fixed period, but then pretty much every year or every 6 months, it's going to move up or down with the market. and an adjustable rate mortgage could be a good thing because the initial rate is lower, but you run the risk of it being higher later. So you just don't know what's going to happen 5 years, 10 years, 20, 30 years from now. 30-year fixed, same interest rate all the time. Temporary rate buy down is still a normal 30-year fixed loan, but you're taking pretty much seller credits or seller concessions to lower that rate for the first initial period. It could be 1 year, 2 year, or 3 years. And that helps the buyer by having a lower monthly payment for the first couple of years. And then they know that their interest rate is still not going to be higher in the future because it may be locked in. So to maybe help illustrate it better, I'll use real numbers.
Kind of build up to their monthly payment.
Well, it's reducing their monthly payment. So it's going towards their monthly payment essentially to make it lower.
And then their monthly payment
will go up later. Yeah. The goal here is that we're hoping if they do a temporary rate buy down today, that hopefully interest rates are going to be dropping within the next year or two so they can refinance and then hopefully have it there. So if someone's doing a temporary interest rate buy down, it is important to be like, hey, by the way, in year 2 or year 3 or year 4, your monthly payment is going to be this high. So don't just think you're always going to pay this amount and think that rates are going to refi. Like we hope they'll refi. They're probably going to refi. But what happens if you're not able to refi? Like be prepared for the worst case scenario. But it's nice because you know the worst case scenario. With the adjustable rate mortgage, you don't know the worst case scenario. Like they could just keep going up.
Yeah.
So let's say the rate today, let's say someone's getting a 7.25% interest rate and they get enough seller credits to where they can cover some closing costs and say the seller's going to pay for a 2-1 buy down. So we've got 3-2-1 buy down, a 2-1 buy down, or a 1-0 buy down. The first number there that I'm saying is the amount of reduction to the interest rate. So a 2-1 buy down, the 2 would be a 2% reduction from that 7.25 down to a 5.25. And that's for the first year. Now the second number, the second digit there in a 2-1 buy down is a 1. That's the second year. So in the second year, they would have a 1% reduction in their interest rate. So at a 7.25 with a 2-1 buy down, you've got year 1 is at 5.25, year 2 is at 6.25, and then year 3 and forevermore is 7.25. So it's helping them get that lower rate for that first year or two, and then hoping that we can refinance. If rates are 5% next year, then great, they can refi right at that time and get out, not have to worry about ever hitting that 7.25.
That's awesome. That's good to know. That's a good explanation too, because especially now, I mean, we've never really had to use anything like that.
Yeah, if you would ask me a temporary rate buy down 18 months ago, I would have said, I studied that in my licensing book and was like, this is something that they told me like, this is something you're never going to use. It's never going to be applicable. And like,
just kidding.
Here we are.
It's kind of like the appraisal waiver.
Yeah.
Like, what's that? Everybody's like, was appraisal waiver? We're like digging around trying to find it. It's 2020. You're like, what do we need these for?
Yeah, but that's what I love about the real estate market is like doesn't matter how long you've been in the industry. It's like every market always has something different. Like it's a seller's market, it's a buyer's market. Lenders are offering this. All of a sudden, out of nowhere, every lender's like, "Oh yeah, we can do a temporary buy down. We can do a temporary buy down." Like everybody's doing them, and you just get these people adapt to the market. I mean, there was when 2022 and 2021 when it was like everything was multiple offers and cash offers. All the lenders started coming out with these cash offer programs, like we'll buy the house cash and like sell it back to them, and things like Ribbon and those buy before you sell programs all started coming out. So it's always something new, and like 6 months from now, who knows what we're gonna be talking about.
Do you see the temporary buy downs? Are those available on some of the investor loans?
They're not available on investment. Yeah, so that's one of the hard things is they're primary home, second home, conventional, FHA, VA, all are good for temporary rate buy downs, but not on an investment property.
Only if you're gonna live in it. Well, man, you gotta live in it. Dang. That's interesting though. It makes you wonder what other stuff are they going to pull out the book that we haven't seen.
Yeah.
They're like, oh man, we ignored that, and now in a year they're like, oh, we're going to use this now. Makes you wonder what changes. It's never the same. I agree with you. It never, like, every deal is different. Everything we do is just different. It's always adjusting, always changing. That's what makes it fun versus just the same thing over and over and over. So. Talk about some investment loans. Kind of give me talk a little bit about. I like to talk different stories. Maybe give us a story. So maybe something that someone should pay attention to that, if they're an investor and they need to get a loan, like what's some of the stuff they should know or pay attention to, or maybe something crazy you've seen. You're like, oh, that was an odd situation.
Definitely seen some crazy stuff, and I always tell myself I need to just write a book of like the crazy loan scenarios or the crazy like real estate transactions, and I just have never got to it. But like all the stories, and now I can't remember them all. I'm like, man, I wish I would have documented some of the things I've come across. But I mean, as far as investment loans go, you're really fitting into two main categories, and the first one is just a traditional conventional loan. And in that situation, you're qualifying based on your personal income, your personal credit, and you're going to get better terms and like get 30-year fixed traditional type mortgage stuff. The other option that a lot of investors are doing now, especially, are DSCR loans, so debt service coverage ratio,
Yep.
and they're qualifying based on just the income of the property. Can the property cash flow? Are you generating enough rent to offset the monthly payment? Right now, DSCR loans are really hard too because prices are high and interest rates are high. So just to even hit like a decent DSCR ratio, is really difficult. It's hard to find a property where the numbers actually work. So, my recommendation to investors is like, understand that you're probably gonna need a little bit more down payment, especially if you go DSCR route. You're gonna need more down payment to get the DSCR low enough to qualify. And lenders have all sorts of different requirements. Since we're a brokerage, we shop between a bunch of different lenders. So I've got this lender does this type of DSCR, this lender does this one. This one's got better rates, but a higher DSCR requirement. And this one allows first-time investors and this one doesn't. And this one's a maximum 70% LTV, but this one's a maximum 80% LTV. So there's just a million different scenarios and options, especially on the DSCR line side.
Yeah.
Whereas on the conventional side, like everybody's falling in with what Fannie Mae and Freddie Mac say for conventional guidelines. So those are pretty standard across the board. So if someone's an investor and they're looking at purchasing properties now in this market, it's like, first understand which bucket you're going to fall into as your best option. And maybe you can qualify for both. And now it's going to depend on when a property pops up, which route you want to go. So if we can qualify you for both, great. And now you're armed and equipped with all the options. But yeah, I'm seeing a pretty equal mix right now between investors just using conventional and investors using DSCR.
Do you see any common trip ups or mistakes or things that maybe slow things down or just make it harder for investors as far as getting loans where you're like, man, I wish, we see this all the time. I wish it could just be one big announcement and be like, guys, just don't do this and we can get you squared away.
Well, I mean, definitely make sure your credit's good. So higher credit score is going to help you in every scenario. The second one is probably having liquid reserves. So a lot of people think, well, oh, I'm ready to buy my next property. I've got 50 grand saved up and I need 50 grand for the down payment. Well, you need closing costs and now you own 3 properties. So the lender's requiring reserves or savings. They're not going to let you have 3 properties and after you close, you got $0 in the bank. You've got to be able to have some extra savings on top of that. And investors like me, when I was a young investor, it's like you're just ready to do the next deal. So as soon as you hit that mark in your bank account, great, I got 50 grand, I'm ready to buy a property. You maybe need a little bit more savings.
Is there a certain number you would tell somebody? Hey, get to this or get to that, hold this amount?
Yeah, about 6 months of payments for each property that you own. So do the monthly payment on each property, multiply it by 6, and add all those up depending on the number of properties you have. And that's a pretty good threshold. And that's probably what you want as a financial security for yourself anyways. What happens when 2 or 3 tenants move out and, your house has an issue and you don't want to file an insurance claim and you lose your job? Like you want to make sure you've got some savings anyways. So most investors kind of get there, but I would say there's a decent amount who come to me where they're just like stretching to try to get to the next deal and they don't have enough reserves saved up. And then the last one.
You just made Misty's mind tick. She looked at me and was like she's
calculating how much money I'll have in savings. She's like, uh-oh.
She's our money person, right? Like, I'm not the one that pays the bills and runs it. So I'm like, she looked at me and I was like, her mind's working right now thinking about this much. So 6 months reserves, and there you said there was another one that.
Yeah. So credit, reserves. I can't remember the third one I was going to talk about. That was literally the most important one.
Dang it, Misty.
I'm joking. Say that. What was the question?
You said 6 months.
Say the question again. It might refresh.
So the common things you come across that maybe stops things with investors where they have trouble. It's either credit. You mentioned credit score. The other one was they come to the table with not enough reserves. They're like, oh well, I have 50,000, but I want to go ahead and just because I know I've done that. We were like, well, I got the money.
Right.
Let's just put a down payment. We're done. And they're like, no, you need some reserves.
Yeah.
Yeah.
Yeah. So I guess two other ones, and I don't think this was the really big one I was thinking of earlier, but one is obviously when you're filing your tax returns, if you're self-employed or now you're starting to get properties, working with a CPA and working with me or your mortgage professional to make sure you're filing your taxes that's not going to set you up for failure for your next property and your next property, and especially if you want to refinance. So investors are notorious for trying to write everything off.
That's why Missy's laughing.
Which is all I hear. I can tell. I was like, I'm picturing your tax returns in my head, and all I see is everything written off, and then having to have the conversation. But like that's where the DSCR play comes in, or a bank statement loan. So there's the options for the self-employed people who want to write everything off, but you're going to pay for it because you're going to have a higher interest rate and harder qualifying, higher down payments. So, I strategize with a lot of my clients and a lot of my investors before they file their taxes. They'll send me a copy of their draft. I'll rerun all their calculations, see what their qualifying income is going to be if they file that return, and be like, hey, you're writing off too much stuff if you want to buy a new house, especially if you want to buy a new primary residence. Mm-hmm. So not even just buying investment properties, but hey, we want to upgrade and get a new $1 million house this year. Well, you wrote everything off, so you're putting yourself in a bad position. So looking at the
how many years would you say they need to not write everything off?
You need a 2-year average. Yeah. So depending on the situation, like I can't fix the past. So if you already filed your 2022 taxes, we got to work with them. And maybe now you're looking at what am I going to file in 2023? So if you really wrote everything off in 2022, you might have to claim even more income, like less expenses in 2023 to help offset or average that. And sometimes the loan programs will allow for only 1-year tax return instead of 2, but all of them are 2 across the board. If you can get 1-year tax return, that's really good because now I don't care what you wrote off in the previous year. I really just want to look at this year.
Yeah. Are there certain things they don't look at where they're like for instance, let's say someone goes and buys a Tesla and gets a $7,500 tax credit or whatever. That's something you guys don't look at. Or do they say, hey, no, that's included in all of that?
No, a tax credit is great because that's not really tied to your income.
Yeah.
So they're looking at adjusted gross income, and they're looking at all the different line items of the tax returns of what you actually claimed as income after your expenses. But tax credits, like, hey, I've got 3 kids, so I get child tax credit. And hey, I'm married, so I file a married joint, and I bought a Tesla, so I get this. Those are after the fact, so those don't matter, the credits there. But there are certain expenses that get to be added back, primarily is depreciation. Mm-hmm. So if somebody has a lot of depreciation expense, that's a way to write off a lot of income, which is one of the biggest benefits of real estate is depreciating those assets. And that one actually gets to get added back in. So that's a good expense to have because it lowers your taxes and it doesn't hurt your mortgage qualifying ability.
Yeah. Yeah. Makes sense. So bank statement loans, that's something that's not talked about much. So we're DSCR. That's kind of where we've been for all those years. So I don't think
I think you got that from me laughing.
Yeah.
So bank statement loan is good. Like
most people don't know about that they exist.
Yeah. So DSCR can only be used on an investment property. It's got to be a business purpose property. Mm-hmm. So you can't, if you want to buy your new house when Missy's like, all right, I'm ready for the new house. I'm tired of where we live. And it's like, well, you wrote off everything on your taxes and you can't do a DSCR because you're going to live there. Yeah. You may be looking at a bank statement loan. So with the bank statement loan, they're going to say, we're not going to look at your taxes. We're going to ignore your taxes because we know you write everything off because we know you're self-employed and you don't want to pay the government. That's okay. We're just going to look at all your bank statements and all of the deposits that come in from your business. And then we're going to take a percentage of that and we're going to count that as your qualifying income. So even though you write everything off, we're just going to say like 50%. Or sometimes you can get like a letter from the CPA to count a little bit less depending on the line of the business. So that can help someone qualify better. The bank statement loan is good. It's kind of when it comes to like interest rates and qualifying, it's kind of the middle ground between a full DSCR loan and a conventional loan. So normally a bank statement loan is going to be 1 or 1.5% higher in interest rate than a traditional conventional loan. And a DSCR loan is usually going to be like 2% or 2.5% higher than a traditional conventional loan. So if you're able to do a bank statement loan, that's a good option. To qualify for that, they're either going to need 12 months of your bank statements or 24 months of your bank statements for all your business bank accounts. That one's fun when I get investors and they're like, yeah, well, I've got 6 businesses. I've got all these different bank accounts. And I'm like,
got like 40 bank accounts.
I need 24 months of all of those bank accounts. Like just clicking and downloading it to 24 months back. Like that's a
takes a week.
3-hour project.
We took that profits first method and 10x that shit. It was like, bow. There's so many bank accounts.
Yeah, we got kicked out of one bank. They said we can't open anymore.
Too many. Wow. Go to Wells Fargo. They just open bank accounts for people. So.
Yeah. I was actually one of the places we were headed,
bank.
and then we ended up at North Texas, we did at one point, and then I think that became an issue, and then we were like, well,
I got kicked out of one bank because they thought I was being fraudulent.
Right,
opening all these bank accounts.
Getting all these transfers back and forth between them. I moved $300 here and then $1,000 there and $5,000.
We didn't even get that far. We opened like 5 bank accounts, and then I kept saying we have more, and they shut us down.
Yeah, that's funny.
Yeah, I actually walked across the street because we needed to open 2 more accounts somewhere at the bank we were at for years, and they were like,
You're maxed out.
You're maxed out. And so I looked at Misty, and I was like, want to go right there? They were like, no.
Never heard of a bank saying you can't open any more accounts.
Yeah, they were like, no. And so we do property management, which requires us to actually hold a substantial balance. I mean, it has to stay there. So it's not like they can't just pay. It's not like they can't make anything off of it because we're not. You're all of that security deposit has to stay. So I mean, they're going to make it back some way or another. I would believe so. So talk a little bit, just kind of investing, just one thing I like to always ask is crazy stories. Maybe you have something, or maybe you have a property that you purchased that was like, it was a home run or something memorable. It could have been wild or a screw up, or it doesn't have to be like a home run, but kind of talk a little about your own just personal investing experience, or maybe you haven't had as much wild stories and you just been, things are calm, but I mean, what does that look like? Give me something that's memorable for you.
Yeah. I mean, like all the crazy things happen, like a tree branch fell through a roof and like the tree was sticking through the ceiling, and my tenant texts me and says, there's a tree in my living room. And I'm like, I'm picturing like, oh my God, like the whole tree fell down in the living room. He literally texted me like, there's a tree in my living room. It came through the roof. Yeah. And I knew there were storms that night. It was in like Keller. And I'm like, oh my gosh, like send me a picture. And I'm like, this is gonna be insane. And it's like barely a little branch poking through like this far through the ceiling. Now, yes, it had gone through the whole roof and then there, and it was just like one branch, but it wasn't the whole tree. And I'm like, all right, you exaggerate a little bit. Like we'll get it patched and like we'll file the insurance claim and they'll fix a like they didn't replace the whole roof. They just fixed the little spot and that was it. So dealing with some like tenant exaggerations, I feel like everybody goes through that. I've had projects where like we're doing new construction and like things stolen and, materials stolen and that kind of stuff. There's this project that was in like East Dallas and not the best neighborhood, and it's kind of a gentrification area and gentrification project. And things got stolen off that job site. So we're like trying to put a fence and put more cameras.
That's East Dallas. So you're talking about all the White Rock area?
Not really White Rock, like east of downtown, like straight east. If you take Main Street east, it turns into Columbia. It's like a mile from downtown. So we built some townhouses that have like rooftops, little things, and like they overlook downtown. So really cool. But really, like to me, the funnest story is like that first deal you do and that feeling of the first deal. Everybody's scared on their first deal.
Oh yeah,
it's
absolutely.
Like the nervousness. It doesn't matter how good the numbers look or like how safe the deal is. Like even house hacking your own first deal, you're like, well, what happens if I lose my job? And what happens if the tenants move out? And what happens if the air conditioning breaks and all this kind of stuff? And like after you do multiple deals, you're just like, yeah, whatever, I don't care. like it all works out. Like real estate, like it's always gonna win. In the long run, I'm gonna win. So the very first deal I bought, I was trying to buy my primary residence, remember, VA loan, and I finally had the full-time salary job for the mortgage company, and so I'm just shopping the market with my agent, and I found a property that was tenant occupied, and it was for sale by the investor, and I was like, it's in Flower Mound, 3-bed, 2-bath, and I was like, oh, maybe I could buy this one and have my roommates. So I contacted the agent, and she showed me the house, and I was like, all right, I want to put an offer in, and she said, well, you can either you can move in and the tenants will move out, or you can keep the tenants in place, either option. So I went under contract on it without knowing if I wanted to go live in it or just keep it as an investment. And then a week later, another house popped up, that townhouse. It was the new construction in Louisville. And so I bought that one with my VA loan. And I was like, okay, well, I'm going to live in this one. I'm going to keep that one as a rental property. So now all of a sudden I went from like, I was going to buy a primary residence that I had to figure out. I wanted this one because it was going to be a good investment property, and I wanted my primary residence. So at that point, I actually partnered up on that deal 50-50 with someone else because I didn't have enough money to do the whole down payment on the investment property itself, plus buy my primary residence. So I ended up closing on these two properties in the same week for my very first properties. And I remember the nerves of like, oh my God, like not only is this deal going to work out and I'm inheriting tenants, are they going to be good? Like, is the house junk? And I'm buying my own primary residence. And like, I just dove in on that, and was super nervous at the beginning. And then and at the end of the day, both properties turned out great. I still own the townhouse. I actually sold that other rental property a couple years later. And obviously at that point I had a lot of appreciation. I was like, oh, that's great. I freaking made a lot of money. And now I'm sitting here like, damn, I should have kept that a few more years. I would have made triple the amount of money if I would have just kept it a little longer. But I thought I sold at the top of the market and I missed the boat. So yeah, those are, just kind of some of the fun stories. And
for you, is the strategy just a lot more buy and hold, give you a chance to focus on what you're doing as far as, the mortgage business? Is that kind of everyone has such a different strategy? Is that kind of what your main focus is? Or
yeah, I would say in the first 3 years or so, I was kind of like, just let me try anything and do everything, because just any way I could do a deal and be involved, I would. So partnering on a rental, buying a long-term rental, doing a house hack. I mentioned I did a flip with a partner, so he kind of GC'd it and I was kind of the money person, and we partnered on that. I did a couple private money loans to some other investors that I knew. So I'd do a $10,000 or $20,000 loan here or there for them to be able to do a flip, and pretty much just finding any way to do some deals. And I also started investing in more commercial and syndications and stuff. So at this point, I'm much more focused on passive investing, bigger deals, syndications, so I can focus on my business, my active business. It just became too much of trying to run and grow a big company, as well as dealing with trying to be fully active in real estate investing. But now I've got a handful of rentals still that are single family rentals. I've got a lot of money invested in various syndications of apartment complexes, senior living, self-storage, and a couple developments. And then I own 2 short-term rentals, Airbnb, one lake house and one condo in Florida at the beach. And I use those as my goal is to buy a couple different, short-term rentals where I can go visit and have family vacations. And we go there a few times a year, but obviously pay for it. And that's the long-term win for everybody. Hey, I own a bunch of properties wherever I want. They're getting paid for. I go visit them when I want to. And yeah, so those 2 are good because they're making money and I get to stay for free.
Do you have a certain strategy not strategy? Do you have a certain type of class you like? Do you like single family, or do you prefer the, syndications, or is there a certain one that you're I really like that more than the others? Or
I mean, I like the syndications, especially for someone who's not trying to be active investing, obviously, but you have to find the right sponsor or general partner to be the syndicator, because you just don't want to give your money to some random person and then they do a bad deal. So you got to really trust the person you're investing a syndication in, because you don't have any control. You're just putting your money in there passively. But I do single family, long-term rentals, 3-bed, 2-bath, 1,500 to 2,000 square feet, B-class market. To me, that's the prime stuff. I don't want to do C or D class, $100,000, even though they may rent at a higher rental rate. They're not appreciating like a nice, suburban 1980, 1990, early 2000s house. They appreciate better. You get a better class of tenant. It's a little less, pain and headache. But
I would say less headache. Tenants are, because the tenant, man, that tenant pool can get real rough at certain times.
I had a question about lending again. So as an agent, a lot of people work with buyers that maybe have recently changed their job or just recently went self-employed or something like that, how does that affect approvals on loans?
Yeah, so pretty much every loan has a requirement, just like the 2 years tax returns, the 24 months bank statements. They want to see a 2-year history of employment and income. And the underwriter is trying to determine, is your income going to be stable and continue going forward? Based on your past history of the last 2 years, does it look like it's stable going forward? So if you're switching jobs and you're in a similar line of work or a similar role, it's pretty straightforward and you can qualify without any headaches normally. Where you get into tricky situations is when the pay structure substantially changes. So if you are going from W-2 employed to self-employed, now you need a longer history. You need at least 1 full year self-employed tax returns before they'll even consider counting your income to qualify. So if you just became self-employed this year, I've got to wait till you file your 2023 tax returns to be able to calculate some income for you. If you switch from a full-time salary job and now all of a sudden you're making a bunch of bonus and commission, same thing, you're gonna have to wait at least a full year, but they typically want you in the 1 to 2 year mark of getting that variable type of income. So people get in trouble when they have variable income because it's harder to predict if you don't have a history. Just because you just switched to commission and you made 50 grand in the last 2 months doesn't mean that the next 2 years you're going to be making 25 grand every single month. And I mean, that's a common thing we get from buyers when they fill out their application. It's like, oh yeah, I worked a lot of overtime this month, so I made 10 grand this month. And you're like, well, no, your average over the last 2 years is 6 grand. Like just because you worked a lot last month doesn't mean you're going to be able to do that every single month and always pay this mortgage.
Awesome. So kind of close it out a little bit. I like to ask this question kind of here towards the end all the time is advice. Anything you'd give maybe to other investors? It could be mortgage related. It could be just, things you've gone through or whatnot. What kind of advice would you give to somebody who's listening? Maybe someone getting started or maybe someone's been in for a little bit. What would you, just your experience, what advice would you give somebody that came to you and said, hey man, what advice would you give me on investing?
Yeah, I mean, I guess for people getting started, like we've kind of hit on the theme here of like you're gonna have the fear, you're gonna have the doubts and be scared, but you just gotta jump in. Like I started my own business after I closed 12 mortgages, and I run the biggest mortgage team in Texas. Like it happens, and you can do it if you're really consistent and dedicated to it. So don't let the fear paralyze you, and don't let analysis paralysis take you over. So that would probably be one piece of advice to the newer people starting out. People who are more established or experienced, I would recommend, if you're hearing this and you think, oh yeah, that's me, I'm established and experienced, I want you to shift that mindset and be like, okay, maybe I'm established and experienced, but have that mindset like you're new again. So many people get complacent in where they are and think, oh, well, I've been successful so far. Well, yeah, you're successful. It's been an easy fucking market for the last couple of years. Like I know lots of mortgage loan officers, lots of real estate agents, lots of investors who made a lot of money in 2019, 2020, 2021. And like, we're all starting from scratch right now. So you got to get back to the basics, hustle, have the meetings, do maybe you're driving for dollars. Maybe you're sending out the, listings. Maybe you're doing open houses. Maybe you're just prospecting your leads and following up with your database, like all those little basic things that you've got to get back to doing. I'm doing them, like being consistent and just doing the activities. Cause if you don't continue to do it, you're going to fall off, and some Nick, the new guy, is going to come in and they're going to be the next big thing, and you're going to be washed up.
I love it. What got you there is going to keep you there. Yep. I love it. Well, awesome. Tell anyone who's listening, let them know how can they get a hold of you guys, your team, or if they have any, need help or, with getting a mortgage or anything for that matter. How can they get a hold of you guys?
Yeah, I'd say best thing is just connect with me on social media. I'm very active on social media. I post a lot of good content and information about just what I'm doing. And it's, business advice, leadership, sales, real estate, mortgage, all sorts of good content. So they can follow me on Instagram. Chief Loan Officer is my handle. They can find me on Facebook, look up my name. And if you are interested in looking at pre-qualified or talking more about, starting your investment journey or purchasing your next house, then I'm happy to have that conversation to help.
Awesome. Yeah. Guys, if you are, I agree with what you said. If you're looking to start the journey, it's always good to do it with someone who's done it. And it's helpful, versus just like call someone random. So do hang around those that you're already around that are doing what you want to do, and you can guide someone. So Tyler can guide you guys. So, well, awesome. Well, Tyler, thank you very much for coming on. Much appreciated. I know you got limited time today. And thank you for sharing your knowledge, and hope to have you back soon. And guys, we will catch up with everybody next time, and that's the show.
Yeah. Thanks for having me.